Hey guys, Mike here. So obviously Uncle Jerome Powell spoke today and the markets did not like what he had to say because boy, they went from pretty green to red. And I went ahead and broke some clips up for you and cut this thing down to like 4 or 5 minutes of him speaking. And there was one answer he gave because I'm looking at the charts and I'm listening to him speak on every answer he gives to see how the charts are reacting. And when he gave this one answer, boy, the stock market just went, see you later. All those gains, gone. Everything started going red. Then he had a chance to clarify it again. No. Another chance to clarify. No. And so I'm going to show you those snippets of exactly what he said. And, we'll talk about why that is so important for this market where it is at right now, okay? So if you get anything out of it, hit the like and subscribe button, and let's go ahead and hear from Uncle Jerome.
The Federal Reserve, we are strongly committed to achieving the monetary policy goals that Congress has given us: maximum employment and price stability. Today, in support of these goals, the Federal Open Market Committee kept its policy interest rate near zero and stated its expectation that an increase in this rate would soon be appropriate. The committee also agreed to continue reducing its net asset purchases on the schedule we announced in December, bringing them to an end in early March.
And so the market's still okay right here, guys.
Inflation remains well above our longer run goal of 2%. Supply and demand imbalances related to the pandemic and the reopening of the economy have continued to contribute to elevated levels of inflation. In particular, bottlenecks and supply constraints are limiting how quickly production can respond to higher demand in the near term. These problems have been larger and longer lasting than anticipated, exacerbated by waves of the virus. While the drivers of higher inflation have been predominantly connected to the dislocations caused by the pandemic, price increases have now spread to a broader range of goods and services. Wages have also risen briskly, and we are attentive to the risks that persistent real wage growth in excess of productivity could put upward pressure on inflation. Like most forecasters, we continue to expect inflation to decline over the course of the year. We understand that high inflation imposes significant hardship, especially on those least able to meet the higher costs of essentials like food, housing, and transportation. In addition, we believe that the best thing we can do to support continued labor market gains is to promote a long expansion, and that will require price stability.
Translation: if you are poor or lower middle class, expect a lot more of your paycheck to go towards paying for groceries and energy, gasoline, food. God forbid you eat out right now. That kind of stuff, and expect your savings to be depleted while they sit on their hands up there. So now we're still kind of okay. You can see by the chart here, the stock market started actually running up before, once the word got out of what he was going to say in his opening statement, gave it all back. Then we started trading sideways before the man starts to speak. And as you can see right here, when we start to get close to his statement, it starts to run some more. He starts to speak. It starts to run off, and you go, uh-oh. And then we get to the part of where things fall off a cliff. He starts talking about the Fed's balance sheet and how they're going to handle it, and pay very close attention to this. It's a very short clip, especially at the very end.
To provide greater clarity about our approach for reducing the size of the Federal Reserve's balance sheet, today the committee issued a set of principles that will provide a foundation for our future decisions. These high-level principles clarify that the federal funds rate is our primary means of adjusting monetary policy, and that reducing our balance sheet will occur after the process of raising interest rates has begun. Reductions will occur over time in a predictable manner, primarily through adjustments to reinvestments, so that securities roll off our balance sheet. Over time, we intend to hold securities in the amounts needed for our ample reserves operating framework. And in the longer run, we envision holding primarily Treasury securities. Our decisions to reduce our balance sheet will be guided by our maximum employment and price stability goals. In that regard, we will be prepared to adjust any of the details of our approach to balance sheet management in light of economic and financial developments.
This is it.
The committee has not made decisions regarding the specific timing, pace, or other details of shrinking the balance sheet, and we will discuss these matters in upcoming meetings.
So Jerome, would you like another chance to clarify that? Maybe put a little detail behind it with some plans?
So at this time, we haven't made any decisions about the path of policy. And I stress again that we'll be humble and nimble.
And for a third time, maybe you can turn the market around. Would you like to clarify again what the plans are? Do you have any, Jerome?
We know that the economy is in a very different place than it was when we began raising rates in 2015. Specifically, the economy is now much stronger. The labor market is far stronger. Inflation is running well above our 2% target, much higher than it was at that time. And these differences are likely to have important implications for the appropriate pace of policy adjustments. Beyond that, we haven't made any decisions.
And of course, it's a big deal because what did you hear for the last month, especially this last week with this meeting coming up? We need clarity. We need to get uncertainty out of the market as much as we can. So even if he came out and said, hey, we're going to raise rates March, July, September, December most likely. Those aren't in cement, but that's the plan. And then maybe we're going to start most likely shrinking the balance sheet, which is huge. Maybe starting in the second half of the year. At least at that point in time, the market could start to price that in. Would there be more selling off? Probably, because it's going to start pricing it in. Now you're getting exactly what started at the beginning of the year. You're just getting a whole bunch of uncertainty, which is what scares the market. Now we're still sitting here with uncertainty. Okay, you heard him say 3 times. We don't have any plans. I'm not sure what they do in these meetings because they last quite a while. To come out here and tell me you have no plans, nothing. Just saying, yeah, well we're in the asset purchase of March. We already knew that. They said that last year, so we already knew that was going to happen. Great, that was already planned out. I'm glad we're following through with that. But to have no plans on interest rates, no plans on the balance sheet, and to keep saying, yeah, we know inflation is, and if you didn't watch my video yesterday, I'll link it to the end. When they start raising interest rates, and he has said this before, somebody told me in the comments, and I went and found it, that when they start raising interest rates, that is not going to have an effect on inflation for like over a year. At least 12 months. And I'll link my video from yesterday so you can see exactly what I'm talking about. When they raised rates from 2015 through 2018, it did. Actually, matter of fact, inflation went up, believe it or not. Okay, they didn't have inflation when they started raising the interest rates, and then it went up to from 0 to 2.3, I believe it was. And so that's going to take time. And the fact that there's just still no plan in place. We're just going to see, even though we know unemployment is down below 4%. He keeps talking about how strong the jobs market is. Even I'm still continuing to see help warning signs. And of course, he did say, yes, they're worried about the rise in wages. That's a huge problem. But it seems like they're just saying, you know what? Sorry for these super high prices, but we're not going to do a whole lot. We're just going to sit here and wait this out, I guess. I mean, that's what I'm getting from them. And they'll keep talking about it. He got asked questions. Hey, last time you guys raised them after every meeting. Are you going to do that this time? The answer is we don't know. Okay, great. Are you going to do it every other meeting? Like anything. People were just digging. Like, come on, man, give us anything. And you just wouldn't do it. And so now tomorrow's going to be interesting because now we get to see. Right? All this uncertainty still. This is what people were waiting on to see if they'd at least lay out the game plan, give people an idea what's happening with these rates. Is it going to be 3? Is it going to be 4? Every other couple months, every meeting. Anyway, that's what I got out of it. And you can see by the chart, I mean, we're well below 10% on the NASDAQ at this point in time as far as, it's obviously being corrected or in a correction. You see where the 20% sell-off is as well. And so we ain't but about 5% from that, I believe. So we'll see what happens tomorrow, guys. Let me know your thoughts in the comments. If you happen to watch the whole thing, it tends to draw out because they got so many questions at the end. But I did the best I could to just put it in a short video for you, so you get something out of it and stuff. So hope you have a good one, and I'll see you tomorrow. Maybe we'll have some green. You never know.